Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Megacap tech led by Nvidia dragging the S&P 500 lower after CEO Jensen Huang's presentation at the Las Vegas trade show failed to propel the AI chipmaker to new heights. Meanwhile, hot U.S. data pushing Treasury yields higher, inching towards that 5% level, while President-elect Donald Trump reiterates interest rates are too high. Also taking a stronger foreign policy stance, by the way, from Greenland to Panama, even the Gulf of Mexico on the agenda. We're going to dive into the details. Lizzy.
Well, it was yields up, stocks down, Kriti, in the session yesterday. The 10-year now at 4.6%. We have seen Fed cut bets eroded in the first half off the back of that eco data. Now you've got a bit of optimism on Wall Street, but for the European session, down 0.4% for futures. Euro dollar at a 103 handle, around its lowest in over 2 years. The countdown to the opening trade starts right now.
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
The CEO of Nvidia speaking exclusively to Bloomberg's Ed Ludlow, talking about, you could argue, two of the main subjects that we're focusing on this morning. There are three, but two of those certainly hit there. The three basically are what is happening with Nvidia, what is happening with Greenland, and what is happening with the bond market. Those are the three main subjects that everybody seems to be talking about. Let's talk about Nvidia first of all. The stock down pretty hard, Lizzy, down 6% yesterday. That's 220 billion wiped off the market cap of Nvidia. Yes, I wonder if you could buy Greenland for 220 billion.
It's not for sale, guys.
Apparently.
It's not some real estate deal that you can just do.
Square footage, that's 110,000 per square kilometre.
A bargain, but it's not on the table right now. Look, Nvidia, Jensen Huang, not invited to Mar-a-Lago just yet. He's got to join the queue, he tells Ed Ludlow. But it, as you say, had a pretty bad day yesterday. I told you that CES speech was a bit underwhelming.
Yeah, meh was their word.
Exactly.
Everybody should have used that yesterday.
Didn't cut the mustard. But he actually did a favour to Samsung because they didn't have the best of results and actually the shares had fallen. And then Jensen Huang stepping in saying, look, they can resolve their technical issues, sort of rescued the stock after that.
When you look at some of the analyst commentary around the Nvidia story, there's a long tailwind is basically what they're saying. They're not saying there's a slowdown in demand. They're not saying their long-term forecasts are looking poorly by any reason. They're just not the A+++ kind of impact that you get from an A++ student.
Were you an A++ student?
I was an A+ student.
Okay.
Just the 1+.
That's the problem, but A+ doesn't cut it anymore. Expectations are so high, and that's the issue here. It's a bit like Novo Nordisk, it's a bit like Nvidia now. Any kind of an inkling that expectations are not going to be met, boom.
It's interesting that part of it was Nvidia, but then it dragged down the entire kind of tech sector as well. So you saw your entire Mag 7, your American Sensational 6, if you will, not actually being able to perform, even though these are completely different business models. So there is a chip-making story here, but then there's a broader concentration risk, despite the rest of the market actually higher. So the net, the S&P 500 only closed like 0.6%, despite a pretty downbeat day for tech. I think that's actually a smaller margin than I would have expected.
I think the Magnificent Seven now make up half of the S&P market cap or something alarming like that. The figures are pretty dramatic. It was interesting, he was talking about quantum computing. I can't even say that. It was down pretty hard as a sector yesterday on some comments from Nvidia. Let's talk about the Treasury market. That's one of the other three subjects that we're watching so carefully around the world right now, aren't we? You've seen yields tracking up towards 5% in the 10-year. The ISM yesterday, the JOLTS number yesterday, both providing a little bit of a reason for the bond market to sell off once again. You got an auction that didn't go down particularly well. Yields at levels we haven't seen on that auction since 2007. How much further do we go, I guess, is the real question now. Do we get to 5%? Do we get beyond 5% on a US 10-year?
So I went over to our markets correspondent, Valerie Teitel's desk this morning, and I said, if you could describe the bond market in one line, what would it be? And she said, there's so many different factors here. There's the deficit, there's the Fed, there's the Trump story, there's hedging, there's the auction. There's so much going on. It's actually very, very hard to draw a narrative. The one thing you can keep an eye on that you're seeing globally, by the way, is a sell-off on the long end. Put it to deficit stories, put it to fiscal risk. You're seeing it in the UK, you're seeing it in France, you're seeing it in the US. Everywhere you go, that term premium story is important.
I was going to say that really feeding into the UK story, it might have been OK for Rachel Reeves after the budget, but when this translates through to long-end gilts, it leaves that headroom that she left herself looking perilous. And lots of people asking, are tax hikes going to be needed? More of them.
At some point in the future, next fiscal event, people are now watching even more carefully. They're watching the minutes later on from the Fed very carefully as well today. It was a hawkish meeting. It had a hawkish tone. We got a cut, but it was a hawkish meeting. We got a dissent. Do the minutes signal that actually more people on the FOMC were actually more interested in a hold than maybe the initial read gave us the idea of? And I'm just wondering if there's the possibility that this December meeting looks even more hawkish in the light of the minutes that we're about to get.
Yeah, absolutely. And how much of that actually has an impact on the yield? I'm looking at a 467 on the 10-year as well. But given that kind of hawkish dynamic, maybe some dovishness, not coming from the Federal Reserve, but coming from Donald Trump as well. He actually made a comment at his Mar-a-Lago press conference yesterday talking about the fact that interest rates are too high, just as Michael Barr resigns. A little bit of commentary, but the first time I think he's so clearly said that basically the Fed needs to cut. And I think that was...
Is that a shock? He's a real estate guy. Of course he thinks that interest rates are too high.
It's not a shock, but I think it is the first time he's directly come out and say it, because you've heard it from the likes of Elizabeth Warren, for example, but this time is perhaps different. Not the only thing, of course, he said at the presser yesterday at Mar-a-Lago, a laundry list. I'll just rapid fire them. Greenland, potentially not up for sale, but still wanting to make Greenland open again or great again. The Panama Canal, not ruling out military force and taking that over. Renaming the Gulf of Mexico to the Gulf of America. Getting NATO spending, defense spending up to 5% of GDP. I don't know where to start.
But, look at the facts here. So he's saying that the US doesn't need anything Canada produces. It should be the 51st state. Some months the US buys more than 4 million barrels a day of Canadian crude, I read. And when you're demanding that all the NATO allies spend more than 5% of GDP on defence, look at your own record. The US hasn't been doing that since the 80s. So how are you going to make this happen? It seems like the only stick he's beating here is tariffs, but yet he managed to get a rise out of everybody, and
everybody's responding to him.
Exactly.
But this is the maximalist approach, isn't it? You say 5% when you actually want 3%. You say we're going to take the Panama Canal when you just want a better deal on the Panama Canal. You talk about Greenland. It's just the go all in and start all in and then work back from there. Seems to be the narrative. European stocks could move on the back of this, though. He talked about the fact that he's not going to build any wind turbines in his 4 years. That in America in his 4 years, that's significant. For the likes of Vestas, watch that today. And defence stocks, if we have to go to 5%, European defence stocks presumably have got significant upside from here. Yeah,
I'll add one more sector to that, which is the shipping story, because although Greenland can be a defence story, absolutely, and a critical mineral story, it can also be a shipping story. I mean, global warming has made the Arctic route actually crucial for shipping. The Panama Canal story, a crucial one for trade and shipping as well, so perhaps some market reaction there. It was an interesting press conference. I don't think we're quite yet fully digested it, and I suspect there probably is more to come. Anyway, much to discuss. That sets us up very nicely for the show ahead. Nadia Martin-Wigan, Sterling Capital Director, is going to be joining us. We need to talk about gas prices. Have you seen what's been happening with oil? It's tracking higher. How high do we go? People are talking about $80 a barrel in the near term. Virginie Maisonneuve, Allianz Global Investors, CIO for Equity, is going to be joining us. Maximilian Euler, Deutsche Bank Research Head of European Equity and Cross-Asset Strategy, out with a note yesterday talking about a positive picture, Lizzy, for European equities. Yeah, and here's what to watch out for today on the data front. So at 1:15 p.m. London time, we're going to get more of a read on the US economy, the ADP jobs numbers coming out. Then at 1:30 p.m. London time, the Fed's Waller speaking on the economic outlook. At 5:15 p.m. London time, the ECB's Villeroy speaking in Paris. And then to wrap it up at 7 p.m, the FOMC minutes, as you say. Lots of eco data, lots of Fed speak to watch, and ECB speak, of course, on both sides of the Atlantic. In the meantime, as we've been speaking, we have gotten some German factory order data that's come out that has moved the euro. We're now down to a 103 handle, a pretty decent move. Let me just bring you through the numbers here. Dropping 5.4% on a month-over-month basis. The estimate was a 0.2% drop. So a pretty significant move when it comes to Germany factory orders guide, dropping the most in 3 months. But not very much the government can do about that right now. It's also an incredibly volatile number.
like really lumpy stuff in terms of just take a look at the longer term chart. It bounces around all over the place. What else do you need to know this morning? Let's run through some other headlines. A fast-moving wildfire has ripped through an affluent area of Los Angeles, destroying homes and forcing thousands of people to evacuate. Around 30,000 people have been ordered to leave their homes after a brush fire erupted in the Pacific Palisades community, causing panic and traffic gridlock. The blaze has now grown to almost 3,000 acres and remains at this point uncontained. JP Morgan is said to be planning to end its hybrid work option for employees, requiring everyone to return to the office 5 days a week. Sources say the bank could announce the change in the coming weeks, replacing an existing 3-day mandate for many of its workers. JP Morgan employs more than 300,000 people around the world. And Bloomberg has learned that OpenAI rival Anthropic is in advanced talks to raise $2 billion in a funding round that would value the startup at $60 billion. Our sources say Lightspeed Venture Partners is leading the round. Anthropic is one of many startups raising billions amid the hype over generative AI. Amazon said in November it was investing an additional $4 billion to boost its stake in this business.
So I did a fireside chat with the partner at Lightspeed who specialises in AI not too long ago, and he was saying he's convinced the next Nvidia comes from Europe. It's nice to see them putting their money where their mouth is, but he says there are 3 problems, right? The engineers are too humble, the regulators are too ethical, and the investors are too cautious.
So companies like Anthropic in the United States continue to dominate. This is a pretty decent spending round. How they spend it, I think, is interesting. What they spend it on, I presume there's a whole load of Blackwell chips that are being lined up on the back of this. But what else are they going to do with the money?
This idea of this kind of bolt-on acquisition approach that is still continuing, by the way, this is coming off of, I think the context is very crucial here. These Mag 7 companies, your Amazons, your Microsofts, your Apples, et cetera, sitting on trillions in cash on their balance sheets. They can't deploy it. Buybacks are too expensive because the stock market valuations are too high. So what do you do as you get your own internal R&D up to date? You buy. This is where Microsoft has this investment in OpenAI. Amazon did that with Anthropic and is now growing even more. The fact that you're getting these funding rounds tied to the Mag 7 space at these valuations brings this idea that you're seeing the issues and concerns in the public markets now seeping into the private ones, and certainly in Silicon Valley as well.
It would be amazing to see Europe doing something like this. I could just feel so unlikely at this point. The science is here. Of course the science is here. Even in the UK, the UK has amazing science in this space. Especially the UK. And yet it doesn't. What is holding us back? If Keir Starmer was to find a company like this in the UK, how transformative would it be in terms of the ripple effect into the rest of the ecosystem? You think about how the UK develops growth from here. Where does it come from? Does it come from the City of London? Does it come from the sciences? Does it come from life sciences? Does it come from the AI community? These are the areas where the UK, in theory, has strength.
And it comes from joining the dots.
But it doesn't. The dots don't get joined.
And someone say that's an easy way to make a valuation play, right? If you believe in the technology and you want to not pay up for it in the States, buy it here in Europe.
Find it here in Europe.
A bull case right here on the continent. Coming up, we're going to stick with that tech theme. We're going to bring you more from our interview with Nvidia CEO Jensen Huang, who says he's ready to meet President-elect Donald Trump. Plus, the new EU Commissioner for Industry tells Bloomberg that Europe must be ready to defend itself from potential tariffs out of the States. That exclusive interview later in the show. And up next, we go back to the markets. We're joined by Nicholas Brooks, head of economic and investment research at Intermediate Capital Group. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is a function on your terminal. This is Bloomberg.
Markets have very much focused on the fact that, you probably will see somewhat more inflation in the short term. They've taken that as quite hawkish, but it's double-sided. I mean, you have it, on the one hand, you have an inflationary impact. On the other hand, there are also some risks to markets if we were to see a more aggressive tariff posture, which of course is a risk.
Love economists on the one hand. On the other hand, Goldman Sachs' chief economist, of course, Jan Hatzius there, talking to the team yesterday. The bond market seems to be in charge of the narrative. US stocks got hammered yesterday. We saw the big sell-off in the US bond markets, deepening speculation about when the Fed is going to be cutting rates. Is it before July? That certainly is what is being priced in now. Inflation seems to be the word on everybody's lips right now, along with yield curves, steepening, all of these kinds of phrases that we're throwing around at the moment. The move is dramatic. Let's put some size and scope on it. Valerie's here to do just that.
Yeah, that's right, Guy. A lot of factors at play here in the Treasury market, especially in the long end. That 30-year bond at 490. Just how much longer until we breach the 5% level? A lot of those factors at play that you mentioned, the swelling deficit, the Treasury supply that the market will have to digest this year, alongside the upgrades to growth and the prospect of inflation being ignited under Trump's economic policies. But let's put the Treasury move into perspective. In my next chart, I want to show just how close we're getting to those cycle highs when it comes to the 10-year and the 30-year. We are 30 basis points away in both of those treasuries from the cycle highs that we saw back in the end of 2023. And remember, that was quite a treasury scare when it comes to the market confronting more treasury supply. That was Yellen when she announced that these treasury auctions were going to get bigger and bigger. We're now 30 basis points away from breaching those levels. Could be some more hot economic data that could take us that leg further. We have Friday's NFP, but before we get to that, we have the Fed minutes tonight at 7 p.m. London time. Be very interesting to see just how close that call was to cut rates in December. And the market will be parsing through this about any hints about how long the Fed expects to be on pause. We're now expecting, when it comes to market pricing, the Fed to be on pause until July. We also want to know just their take on the political situation, what their guise is from the potential economic policies from the Trump administration. They factored this into some of their growth forecasts, into their upgrades, into inflation. We'll want to be discussing, we want to look very closely about what they're penciling in for those potential adjustments to the U.S. growth. That drops at 7 p.m. UK time, those Fed minutes.
There's a lot going on, isn't there? You've got Fed minutes coming up. Obviously, we're watching the data. Payrolls Friday for like a mile away at this point. Seems like we've got an awful lot to get through in terms of the sessions ahead. Valerie, thank you very much indeed. Let's carry on the conversation and figure out what is happening. Nicholas Brooks, Head of Economic and Investment Research at ICG, joining us around the table. Do I sell stocks if I get to 5% on a US 10-year?
I'd say yes, probably. I think we're in a situation right now that's a little worrying. I think we have a lot of contradictions going on. So, for example, as you reported earlier, we saw the services PMI or services ISM in the U.S. very strong, and the prices paid element very strong. At the same time, the labor market is booming along so far. We'll see on Friday. And what I think, and that's why I think what's going on in markets right now is quite rational, is the Trump administration, or Trump's promises in any case during his campaign, were very fiscal stimulatory. So if the U.S. economy is now growing at or possibly above its potential rate, and we're talking about more fiscal stimulus next year on top of what we're already doing now, it's quite rational the bond yields are moving up. But at the same time, valuations are very high in equity markets. So I think if we were to see the U.S. 10-year move beyond 5, we could quite easily see a relatively large correction in risk assets.
How large? And are we now? So we're now basically at the point where good news is bad news. Economic good news is bad news for equities. Is that the right way of thinking about it?
Yeah, I think, what markets really want, of course, is the Goldilocks scenario. So that we want decent growth without too much inflation. And frankly, that's more or less what we've had over the past year or two, which is one of the reasons why equities have done so well. My concern in 2025 is that we've been running these large fiscal deficits. The U.S. economy has been booming along at close to 3%. And now you have Trump coming in saying rates need to be lower. And we want to, cut taxes. It's, it doesn't make sense.
The math doesn't quite add up there, does it? But I'm curious about the move on when it comes to the long end of the curve. You talked about the deficit there a little bit. Is this really a problem? I'm taking the contrarian approach here. Is it really a problem to have yields on the long end rise if it's done in a slow and gradual fashion, as opposed to something like we saw in the third quarter of 2023, where it was the same fears, deficit, housing, policy as well, but it was more of a shock? Does it matter if it's slow and gradual?
No, that's a very good point and a very good question. I think, slow and gradual, you can get away with for a while. But there is a point where the cost of capital becomes a problem for companies. I mean, companies have been dealing with, and by the way, the government have been dealing with much higher interest costs over an extended period. Now, you could say it's a little bit like boiling the frog slowly. You don't know at what point is this going to become a problem. So, yes, gradual probably has less immediate market impact. But the question is, and I think nobody knows the answer to this, of course, is at what level does it start to trigger problems in the corporate sector, and when does it become a potentially an unsustainable situation in the fiscal side?
But the reason that this time is different, one would argue, is that
Love that phrase.
You're welcome. The reason this time is different, potentially, is, especially from the corporate perspective, there's still so much cash on the balance sheets. You're seeing this with the hyperscalers. You're seeing this in Nvidia. You're even seeing this in other more cyclical companies where they're still sitting on so much cash. You're seeing this in households where they're still sitting on so much of that stimulus and that wealth generation. Even though they may not feel it, it's there. Again, is there enough cushion to digest the tariff risk, to digest retaliatory policies? What metric are you looking at for that crack to become clearer when it arrives?
Yeah, I mean, I think a key ratio to look at across the board is interest coverage ratios. And what I've seen and what I think is probably going to be a key theme this year and probably into 2026 is this dispersion of performance. You have larger, mid-sized companies that have good cash flow, that are asset light, that are going to perform well. But then you've got a lot of companies, smaller companies, that have been having issues. And we probably see more cracks coming up there. So I think there'll be this performance dispersion with balance sheets being a critical differentiator for company performance.
I feel like this is a question that we're asking ourselves. When you have a press conference like Trump has just done at Mar-a-Lago, where he's coming up with policies on pretty much everything, what do you listen to and what do you kind of tune out? What's going to have a longer-term effect?
Yeah, again, another very good question. This morning when I saw those headlines, I was a bit surprised as well. I would say that I think ultimately investors are going to look at which announcements seem most credible, and will focus, of course, on the ones that have the most immediate economic ramifications. So I think the two areas that investors will be focusing on in 2025 are obviously tariffs. Those are real, and those will have a real impact, not just at a country level, but at a sector and at an individual company level. And then, of course, the fiscal policy, because Scott Bessent is going to be in a very tough place when he steps into Yellen's shoes, because, if you look at IMF data, we're talking about a U.S. fiscal deficit this year or last year of 7.8% of GDP, debt to GDP gross 120%, and a number that I was just looking at yesterday that surprised me, maybe not some of our listeners, is that U.S. interest payments as a percent of total government revenue, 20%.
It's a very big number.
It's a big number.
And one that's going to continue to be an issue if we track even higher on these 10 years. Nicholas Brooks, Head of Economic and Investment Research at ICG. Thank you very much indeed. Nice to see you. This is the challenge. Tariffs and fiscal policy. That sounds straightforward. How do you? Yeah. But what are you looking for? And Bessent's got so much he could do at this point as well. Yellen issued a lot of front end bills, and she issued at the front end. He's talking about issuing further down the curve as well. That could even further steepen the curve up. There's a lot going on here in terms of even the details within relatively straightforward areas of what Trump is talking about.
Is it scarier for the market if it comes in one big, beautiful bill, all in one go with a hefty price tag?
This is the key point, right, that Nicholas just made. The math doesn't add up, and you have to get the tax cuts in before you get the actual tariffs, or maybe the tariffs before the tax cuts. We'll talk about what the order actually looks like. Coming up, we go to more right here on the continent. Europe has been burning through its natural gas reserves at the fastest pace since 2018 this winter. We're going to dive into the details. This is Bloomberg. 30 minutes from the start of the opening trade. When you look at the futures picture, you really want to keep an eye on all the geopolitical news that may be a little bit of a headwind or potential tailwind for certain industries. Euro Stoxx 50 futures down about 0.4%. Underperformance in France as well. Outperformance over in the States, but not by a massive margin. S&P futures virtually flat right now, 59.59 on those contracts. The bond market picture, remember, in the context of the States where you did see that sell-off yesterday, continues in the German 10-year as well. That might have something to do with the factory orders that we got, a 5.4% drop on a month-over-month basis on a very volatile data set. As Guy had mentioned, the French and Italian yields marginally getting a bid. Maybe a little bit.
So you could think about what happened in the States yesterday. You saw the ISM services, the inflation story was kind of quite clear within that data. You've also seen that within the European data over the last 24 hours. European data certainly signaling that inflation continues to tick higher. Energy prices certainly a factor in all of this, adding to the CPI picture. And you can see that in terms of what is happening in terms of the gas futures. They have been tracking higher. We are up 50% year on year. The region is burning through its reserves gas storage at its fastest pace since 2018. It is getting increasingly cold outside. So how much faster are we going to be getting through those reserves, and how big a problem could this be for Europe as we head out of this winter and into next winter? Nadia Martin-Wigan, Director at Slump Capital, a commodities-focused alternative investment manager, joining us to discuss. Nadia, as I say, it's getting cold. We're starting to think about gas storage. We're going through it pretty fast. How fast are we going through it, and how big a problem could this be?
Good morning. So we're on a trajectory that matches what we saw in 2016-17 and then 2017-2018, where we ended the winter season at 10 to 20% stock levels. When we compare that to where we've been since Russia invaded Ukraine, it's a massive difference. Already the market seems to be thinking that we could be as low as 35-40%, but to come that low, it really puts pressure on imports. And when you have storage dip below 30%, your withdrawals are less efficient, so you can reach that bottom very quickly. In addition, we don't have floating storage of LNG available offshore like we've had the last 2 winters to prevent price spikes if there are production outages for TTF.
So how do we refill? Presumably, if we don't have Russian pipeline gas, that's going to be more tricky. How much extra LNG do we need, and how much capacity do we have to refill via the LNG route?
So if we start with what we know, right now, Russia is no longer transmitting gas through Ukraine. To replace those volumes, which is 15 BCM, that means 1 LNG cargo entering Europe every other day. For that, we have ample capacity. It can very easily be done. If we're down to these low stock levels that I described, we could face demand for up to 400 additional LNG cargoes needing to come into Europe to hit that 90% target on storage for November 1st.
I mean, Nadia, good morning, it's Lizzy. Do you think that the real issues start next winter as you get the storage withdrawals now? I was talking to Javier Blas on Bloomberg Opinion about this yesterday, and I think you're even more pessimistic than him about where the storage levels drop to.
Absolutely. I think that we've just seen how cold weather really draws it down quickly. And we're in a situation that we've already had a lot of demand destruction. Right. So it's not where we were in 2022. So this need for LNG is much stronger this time. And this is, of course, for next winter. But that mandate for 90% levels of storage, that comes from the EU. There are some very big penalties in certain countries if you don't reach that. And the feeling amongst the trading community is that if storage holders don't do it, then the TSO will do it. And when we look at the shape of the natural gas curve in TTF, we can see that summer prices are still very, very high. We don't have the contango we should to build that storage. So it's really looking to be an issue already in the summer to prepare for next winter, not waiting until next winter to really have the shock.
So we're talking about the US ramping up production to make up for this lost Russian gas through Ukraine, to keep Europe supplied. Where do you see it flowing to mainly?
So when we look at last year, US exports of LNG went #1 to Europe, especially the Netherlands. Then it went to Asia, Japan, South Korea, India. what we saw is overall imports of LNG to Europe were down year on year. But then that was immediately almost one-to-one replaced by this extra Asian demand. When we look at what we see in extra production coming out of the US, it perfectly can match what is no longer transmitted via Ukraine from Russia. However, when we're looking at rebuilding the entire storage situation, that would probably require LNG from all sources, even possibly including Russia.
Nadia, when we traditionally talk about LNG, we're doing it from an energy perspective, from a heating perspective, certainly an export perspective. Today's kind of big theme on the show is a lot of the tech story and the data build out, the AI build out. There's a narrative in the States that to do that, to kind of fund that AI growth, to fund those data centers, and also to supply the energy needed to make that sector thrive, natural gas is the way to do it. What does that outlook look like, and how much of a tailwind is it for pricing in that sector?
Absolutely. We believe at Svelland Capital that natural gas is the reliable, fast solution and least expensive solution to have these data centers up and running. When we look at where prices have been in Henry Hub, though, we saw curtailments in production last year. You know, when we're at $3.5, $4 for MMBTU, then we start to see production coming back. And this is where we've been waiting to see Marcellus really ramp up production. But right now, there's such a cold snap in the US that instead of increasing production, we now have cuts to production. Last year, you know, we had a massive cut to production. Granted, it was short term, but this is where we need additional infrastructure build out to make it more across the lower 48 to bring that going forward for the next 5 years.
Nadia, what does that relationship then mean for the oil sector, especially in the United States, again, where so many of the utilities that used oil as kind of that power generator and that commodity for the reasons you just outlined in terms of just how expensive it can be, have switched to natural gas? What does that mean in terms of the correlation between oil and natural gas from a pricing and trading perspective?
Well, they will be increasingly related. And what we also see is when natural gas prices get very high, we see switching back. And so that can continue to happen. One thing that is very helpful for the oil sector is that a lot of shale production has associated gas. With higher gas prices, even where they are just a little bit higher on Henry Hub, it means that producers will be able to produce more oil with less high oil prices and still be above their break-even prices. So it should help the entire sector together, hand in hand.
All right, Nadia Martin-Viggen, Director at Svelland Capital. We thank you for joining us, making time for us this morning. And coming up on the programme, the Nvidia CEO has given Bloomberg his insights on the coming US administration and the future of AI. So we'll bring you that interview with Jensen Huang next. This is Bloomberg. So we saw Nvidia shares slumping after a wide-ranging product presentation by the CEO, Jensen Huang, failed to win over investors in the AI chipmaker. A bit underwhelming. He was also speaking, though, to Bloomberg Technology about plans under incoming President Donald Trump and the impact of AI on the gaming industry.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way. And so the games are going to be more interesting. The characters are going to be more interesting. The content development cost is going to decline. And that's going to be really great for the industry. And so I think that the future is really bright for video games and these virtual worlds. And artificial intelligence is going to really reinvigorate it.
Project Digits. May I pick it up?
Yeah.
$3,000 Project Digits.
Yeah.
A supercomputer you can put on
right
your desk.
Exactly. Could you imagine you're just sitting there just like that? You're working on your PC.
Well, I can't imagine. Why would I need one of these? Probably not me. But how big is the addressable market for this? What is the addressable market?
There are 30 million software developers. There are probably something along the lines of 10 million designers around the world. Probably another 20 million creative artists. Hard to say exactly how many students. I'm going to guess probably a couple of 100 million students around the world. Everybody's going to have to. Everybody's going to have to. Well, they can afford computers, and so if they can afford computers and they would like to have a companion that helps them do AI, this is the way to do it.
Can I just clarify something on it? I think you said on stage Mac OS, Linux, and Windows, but the communication said just Linux.
No. Whatever computer you use, you're literally enjoying how it's going to be used. It's sitting right there, and you just connect to it wirelessly like it's your personal cloud.
I promised the audience I'd clarify that because they're excited. We're running short on time. President-elect Trump has been speaking during the course of our conversation. How imperative is it that you go to Mar-a-Lago and meet with him if Nvidia is America's leading AI company? And will you?
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
A lot of what you outlined on stage last night in the realm of physical AI, I saw Xpeng, for example, in the autonomous driving context. That's happening in China. Like, they are doing a lot on robotics. So I'm going to ask you about tariffs. It's likely this coming administration will be as restrictive on technology export, and tariffs will be a function. How have you prepared for that, Jensen?
Whatever the administration ultimately decides, we'll give them as much insight as we can from our perspective, and I'm sure that the administration will make the right moves. That's in the best interest of our country.
So that was the Nvidia CEO Jensen Huang speaking to Bloomberg's Ed Ludlow. Let's get analysis now, though, from Bloomberg anchor Tom McKenzie. He joins us round the table. Tom, there are a lot of announcements here. Which of them were new, and why was it kind of underwhelming, seemingly, for markets?
Well, I think there's still this gap, and this is something that Ed was pushing Jensen Huang on, which is what is the market opportunity? What is the dollar number that you can put on some of these future projects? And I think that's where Jensen Huang either failed, willingly or not, or was unable to give a number to. And I think that's the mismatch. He outlined, of course, the projects around having a personal supercomputer for $3,000 for programmers, but talked about hundreds of millions of students, but couldn't really give a dollar number on that. The humanoid robots, Ed pushed him. When is the timeline for that? He couldn't really give a timeline. He talked about the fact that this is a company that is a foundational company in terms of software and the chips. They feed into all these different segments. That, though, makes Nvidia reliant on its clients coming up with business solutions that they can actually sell to the public and to enterprise. And that dependency means there is some uncertainty around the dollar numbers, unlike, for example, data centers and that component, and those revenues continue. And on that point, he did come out and say, look, we are still at the very early stages of the data center spend, because, of course, Ed asked him, there's concern about that running out. And he said, we're still at the early stages of that. That has a long way to go. That was a positive. I think, interestingly as well, on tariffs, increasingly, as Nvidia pushes into these different segments, and he talked about autonomous vehicles, for example, they're going to become increasingly reliant, or at least, I should say, increasingly vulnerable to tariffs. And he didn't have a clear answer on that either, maybe for very diplomatic reasons, said they're going to work with the incoming Trump administration. That potentially is a vulnerability for Nvidia going forward. So there's a mismatch in terms of the future prospects of this business. They're outlining all these ambitions, but they can't really yet put a dollar number on humanoid robots, the supercomputer for personal use, and the cloud, the foundational cloud as well, that doesn't seem to have a real commercial use case at this point.
And yet the priorities are very clear, as you outlined there. The diversification, of course, that dream, even things going into like medical equipment, for example, still very much there. That's not something you see in the likes of Samsung. It's also not something you see necessarily in the likes of Tesla, which he actually commented on, that the priorities are right. The execution may take some time.
Yeah, so Ed asked him about what he thinks the impact will be of Musk being so close to, or in fact inside that new incoming administration. And very interestingly, he talked about the fact, Jensen Huang talked about the fact he thinks Musk is hitting the mark on three key areas of AI. He talked about XAI, for example, which is the foundation model part of Musk's empire. He talked, of course, about Tesla, the vehicles, and describing that as essentially an AI company because of all the data that they hoover up and how that positions them going forward. It's worth noting, of course, Musk is therefore a major buyer and purchaser of GPUs. In fact, he's put together this 1,000 GPU cluster, so is a major client for Nvidia. So there's rationale for that. But it's interesting in terms of how Jensen Huang described Musk's approach to AI and saying he's getting it all right on three key areas. Samsung was another story that came out. It's amazing. I mean, Jensen Huang is getting kind of, you know, almost central bank speaker power when it comes to the moves on the markets. He just mentioned one line when it comes to Samsung and the fact that they're working very hard to address the tech issues to get these high bandwidth memories, chips that accompany AI accelerators. They're closing that gap on SK Hynix. He says they're working very fast on that, and you saw the stock moving higher, despite the fact that the numbers that came out from Samsung were very weak indeed, and they have that softness in terms of the demand coming out from China, as well as the competitive threat from China as well. They need to get the accreditation from Nvidia for those HBM chips. They said it was going to happen last year. Yeah. They need it to happen in the first quarter of this year. Yeah.
Tom, great stuff. Thank you very much indeed. T-Mac on tech, thank you. OK, let's turn back to the broader markets. Nvidia was obviously a big feature yesterday of the sell-off we saw in the United States. But you need to roll in the ISM, you need to roll in the JOLTS number, you need to roll in inflation, you need to think about what's happening in the bond market as well. Fen Ram, Bloomberg's M-Live cross-asset strategist, joining us now from Dubai to talk about all of this. Ven, US stocks fell out of bed a little bit yesterday. Nvidia was at the vanguard of that move, but nevertheless, the bond market story is front and centre. Is this sell-off just getting going if yields continue to rise?
Well, I think that, you know, there's the well-known January effect, Guy, when investors are supposed to be in favor of buying stocks at the start of the new year. This time around, I fear that the Ides of January have come to roost the markets. And the market is beginning to demonstrate that good news for the economy is bad news for stocks. Then there is the question of overzealous valuations, with the S&P offering an earnings yield of just about 4%. If you look at the NASDAQ 100, the basket offers just about 3%. So if you calculate the fair value on the S&P 500, it works out to around 4,800 on my model. So the market is basically trading 25% above where it ought to be trading. So it's almost as if you could park a jumbo jet between where it is indicated and where it actually is. So the risk reward at these levels seems skewed is distinctly in favor of a correction. And of course, you've got the Trump inauguration coming up as well. And that is also, investors are likely to be jittery ahead of that inauguration because who knows what announcement is going to come from White House on tariffs.
Who knows indeed. But just to bring it back to the bond story, I mean, you reckon that 5% yields on the 10-year are possible. Why not 6% then? I think that 6% may be over-egging it, Lizzy. I think that having said that, I think that the bear case for duration is well-founded. The MOVE index, which gives a robust indication of what traders are thinking, reckons that 10-year rates will settle somewhere between 360 and 555 in a year's time, and that is with a 1 standard deviation certainty. Treasury 10-year rates have already shot up some 80 basis points since the market started factoring in the Trump trade. So the markets are kind of almost well prepared that Trump might slap some tariffs and stoke inflation. You know, they've partially priced in what he may announce. They front-run it. So it all depends on what he announces and whether he announces anything on January 20. So the pricing means that there's further sell-off in Treasuries likely, and that will be to the tune of 20 to 30 basis points on the 10-year from here. So I think that we are going to tread water around the current levels until Trump takes office, and depending on, they will bifurcate from there depending on what he's going to announce on tariffs.
360 to 555. What a range for Treasuries. Bloomberg's Fen Ram walking us through, of course, that market story. You get more from him and the team. ML IV Go on your Bloomberg terminal is the function. Let's go from the macro to the micro. Here's stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we're going to be watching defence stocks today after Donald Trump had said in an interview yesterday that he is looking for NATO countries to potentially be pushing up their defence budgets to 5% of GDP, something he has already called for, but going more heavy on that call. So these are the stocks we're going to be looking at today. BAE, Rheinmetall, Leonardo, Saab, some of the usual ones we tend to look at. And of course, this sector has done really well over the past couple of years, given the increased pressure on countries to spend more on defence. We could see potential gains in that industry today. Then the other sector I've got my eye on is bookmakers. This is after Flutter in the US warned that it's been hit by unfavourable sporting results. So gamblers doing well over in the US. A lot of that related to NFL, according to a statement from Flutter yesterday. Now, that is mainly seen in November and December, according to them. Flutter, of course, relisted to the US. So a lot of the volume is over there now. But the one to look out for in particular is Entain, because they've got a big exposure with their BetMGM business in the US, a massive part of that company now, and a couple down here, Evoke and Evolution. Also keep an eye on those as well. Then in terms of ratings, Nestle and Danone both downgraded to underperform at Jefferies today, which says that the food part of the staple goods sector is going to continue underperforming. Cosmetics is doing well, according to the broker there. Nestle has been the underperformer, given some weakness in some of their core products, including the coffee business. That stock fell around 25% last year. There's the ratings on Nestle. Only 2 sales on that, but just got an upgrade from Exane as well, so I'm not sure which one's going to have the bigger impact. Novo Nordisk, the other big buy rating, over at UBS, and a couple Zurich, L'Oreal. Keep an eye on those as the market opens today.
All right, Joe Easton with our stocks to watch. We thank you so much. Of course, we are counting down to the opening trade here. When you look at the futures picture, seeing marginal moves to both the downside and the upside. I'm looking at U.S. futures here, higher by one-tenth of 1%. Yeah. European futures are, of course, down pretty broadly.
It's interesting. So there's this argument that Europe is cheap right now and therefore is a diversifier, but it keeps moving kind of hand in hand with the U.S. markets. Do we need to see less of a move in Europe on bigger moves in the United States for that to be true? And is that something we're ultimately going to see today? Keep an eye on the defence sector. Keep an eye on what's happening with the wind sector as well. That can be an interesting story as well to watch out for today. Plus tech, of course. We don't have much of that, but we do have some. Futures are pointing a little negative. The Open is next. Wednesday morning, good morning. Europe's got a little bit of work to do this morning, pricing on the downside after we saw a sell-off in the United States yesterday. We pushed down towards session lows towards the back end of the US session, as you can see, getting close to some really interesting levels from a technical point of view. The bond market, obviously a key feature here in terms of what we're watching. Are we tracking towards 5% on a 10-year? Is that what is driving this risk-off sentiment that we are seeing in US stocks? The growth picture looks pretty good, but apparently it could be accompanied with a little bit of inflation, and the Fed obviously has to react to that. So we've got a little bit of a gap to fill this morning, Lizzy.
Yeah, it looks like it's going to be a negative start for Euro Stoxx 50 this morning, down 0.25% on futures. The FTSE 100 futures just slipping into the red, but so far not as bad as the rest of Europe. Is that because the UK is less in the firing line from Donald Trump? You've got the DAX pointing to a start lower, 0.25%, Kriti. Maybe we see it more in the sectoral picture.
We certainly might, especially when it comes to that German defense sector. And that's going to be crucial when we look at, again, you mentioned it, the Trump effect, when you talk about some of the kind of ripple effects into Europe. The fact that he's now calling for 5% spending of GDP. I mean, look, the U.S. doesn't spend that. We spend about 3% and at the moment. But the fact that we could get there or call for that and that Europeans may have to match it could be a tailwind for the sector. Big emphasis on could. Another Trump effect on the wind and energy sector, of course. Ørsted, Vestas very much in focus. And then Nestle, we're looking for a break from the doom and gloom, perhaps getting a double upgrade to outperform or underperform at BNP Paribas Exane. The broker saying the earnings bleed is finished and there's upside to current consensus to like-for-like sales. Guy, quite the rave review from BNP Paribas Exane.
Stocks come down a long way, an awful long way over the last few months. OK, here we go. Time for the opening trade this Wednesday morning out of Europe. There is an awful lot to factor in, to price in. Let's see how that's reflected in the numbers. Here we go. FTSE 100, we're expecting actually to be fairly flat this morning. A little bit of green, but we're oscillating, I would have thought, either side of the plus and negative line here in London. So the FTSE 100 is up. Elsewhere, I think you're probably going to see a little bit of weakness creeping into the market. The stock 600 is also out of the gate positively, but we'll start to see maybe that changing a little bit as we see the CAC, the DAX maybe coming through, and we'll see what trade looks like in those key markets this morning. There's a number of key sectors that we're going to be watching out for. All of this seems to be trading off what Trump had to say yesterday. We're watching what is happening with the defence stocks. We're watching what is happening with the wind stocks, trying to figure what is going to be happening there. But we've also got, obviously, this big tech story that we need to be pricing into the markets as well this morning here in Europe. Guys, what are we seeing? What is the story below the surface?
Well, before below the surface is kind of what we expected. I think you called this from the beginning, the energy effect, that wind effect. Those are your two biggest contributors to the downside. You're also seeing the likes of Shell, for example, really taking a beating this morning and actually weighing on the entire index. They're talking a little bit about that natural gas exposure as well. We're going to dive into the details later on, but Ørsted, Vestas are certainly down. To the upside, though, you are seeing a little bit of the healthcare sector regaining some of its losses. And your biggest index contributor to the upside is Novo Nordisk, Liz. And I think this one's interesting because, of course, it has taken a pretty big beating, I think 40% or so from last year's highs. On top of that, I just think the timing is so interesting here. On the same day, same 24, 48-hour period where you're talking about relationship between the United States and Denmark, the biggest export from Denmark to the U.S. is Novo Nordisk's Ozempic. I don't know if that's factored into the pricing. It could just be a technical move. But the coincidence is uncanny.
Yeah, we talked about the fact that Donald Trump didn't seem to have a plan of how he was going to get Greenland. Do you get to see it through a tariff? That's your point. Does Novo get hit by it? But also we were talking about defence stocks, and you're seeing the likes of Rheinmetall, Leonardo, Saab, as flagged by Joe, all up in the green this morning. Saab really up 2.5% there. But break it down by sector across the stock 600. You've got about half in positive territory. Financial services leading the gains, up 0.7%. Consumer products and services at the bottom of the basket. And we've just had this report of French consumer sentiment unexpectedly falling amid all that political gloom as well.
Luxury's under quite significant pressure as well. L'Oreal, LVMH down. Hermes is under pressure, I saw just a moment ago. But Vestas is down by 4% now. Donald Trump saying he's not going to build any wind farms in the United States in his 4 years. Vestas is obviously highly exposed, but so is EDP. So are many of these European companies that are on this the energy transition story, this huge move that we could be potentially seeing. So a little bit of pushback there coming through. But the points seem to be coming. Like Shell is down pretty hard. That's adding obviously a lot of points to the downside. But luxury is a big drop today. Few tech stocks down as well. Infineon is down by 1.31%. But it does seem as if defence stocks are doing well. You've got wind stocks not doing very well. Luxury is the other big loser that we're watching here in Europe this morning.
Yeah, and I'm waiting for the full pricing to come in when it comes to the DAX as well. You are starting to get some of the opening trades there. We'll see how that shakes out in terms of that defense story as well. In the meantime, we posed that very question in U.S. programming to Jason Thomas, Carlisle, head of global research and investment strategy, about the Trump effect and what that means for Europe. Take a listen to what he had to say.
We have to wait and see what Europe is going to do in response to the U.S. election results. I would pay very close attention to changes in Europe. It's priced about a 40% discount to the United States. Obviously, market participants are not especially optimistic about the likely changes there. But that provides a pretty significant risk compensation to investors.
Pretty significant risk compensation to investors. Could this be a tailwind for basically buying a little bit of bottom feeding? Let's bring in a true expert, Virginie Masseneuve, Global CIO for Equity over at Allianz Global Investors, joins us around the table. Virginie, we've been looking for a bull case in Europe for quite some time with very little success. Could this be that moment that the sell-off is so strong, that the doom and gloom around Europe is so strong, it's almost too cheap not to buy?
I agree. I think that you want to make sure you're not too underweight in Europe. You could have positive catalyst. It could be Ukraine. It could be more spending coming out of Germany with the new election and the new leader. There could be some green shoots, if you want, that have not been taken into account. All this said, growth is lower, but that's in the price. That's why you have the discount. Rates will probably be able to go down faster, as we've discussed. Trump tariffs is interest rates lower less fast or less cut. So I think all of this puts Europe into a position where if people are very underweight, they should have a position.
When it comes to what actually drives the index, I know so many people right now are talking about the growth story. Yeah. But given that so many European companies have that American exposure, I'm waiting for that consumer resilience story in the U.S. to bleed into Europe. Why hasn't it to a bigger margin?
I think the political element has taken over, to a certain extent in Europe. But you're absolutely right. A very large part of the European earnings are global, and somehow have not been reflected in the stock price. Somehow the concentration of the market, if you want, that we've seen last year in very strong global markets. I think we're up 40% from October 23. Or whatever the exact date is, but we've had 2 years of very strong rally, and I think in that you've had that concentration on the US, on part of tech, and a lot of the other, if you want, less glamorous stories have been ignored. And if you think 25 is a year of volatility, more erratic behavior, as we know, more unforeseen news coming out of Washington, I think you want to have that diversification, and you want to make sure that you find those companies at cheaper valuations with earnings potential.
If the S&P fell by 10%, would the stock 600 fall by 5% or 15%?
So what are the currencies going to do?
Okay.
Because that's the key. Again, if you go back to the tariff topic, if you look at 17, 19, tariffs, you've had a decline of the dollar of about 10%.
Yep.
So your return, are we talking in local currencies or are we talking in dollars? Yeah. In local currencies, I think you could have, given the valuations, and let's put France aside, given the political volatility that might come, I think France will come down less than the US.
Okay. How does that argument go down when you make it to US investors? Because in theory, they've got the strong dollar to factor back the currency story into the mix.
Yeah.
Europe looks super cheap. In theory, that should be a win-win. But when you make that argument, what do portfolio managers say?
Well, so it depends on the time horizon.
Yep.
It depends on, their benchmark. Do they really have a global benchmark? A lot of U.S. investors have a U.S. benchmark and then an international benchmark, and they play with the allocation. But I think there is...
Do they buy the argument around Europe being cheap?
I think they do.
Is it an argument that gets that gains traction?
I think they do. I think what's really interesting to me is to see if in 25 corporate America will see Europe as cheap and if we'll see more M&A.
Okay.
There's a lot of really good assets in Europe. Is there room for more M&A deals coming out because companies are cheap? So in terms of a massive capital allocation from U.S. investors to Europe, I think that's going to be very difficult. Massive, right? I think the home bias, as you know, in many countries, the home bias is still there, particularly if you have a strong currency on a hedge basis, maybe some allocation. Yeah.
Okay. Virginie, we've also been hearing this morning from Jensen Huang, who was speaking to our very own Ed Ludlow, talking about how he's up for meeting Donald Trump but hasn't been invited yet. I know you've been writing about semiconductors, how they're so strategically important, they're like a critical utility but not quite.
Yeah.
I'm kind of wondering if supply and demand is going to be so totally upended by geopolitics. As investors, how should you be thinking about that pricing in the industry?
Yeah, that's really important. And you're right. I wrote, we with the team wrote a note on semiconductors, the new utility. What I mean by utility is it's so critical. It's like electricity. The concept of national security really does that come first versus the concept of profitability? And when you see the ask and when you see, for example, what some companies are doing in terms of building capacity in the US, you have to wonder. So I think it's going to be a mix of both. I think what you'll have is the high end of semiconductors, or the part of the supply chain that's linked to artificial intelligence, particularly if we see that impact on productivity increase from AI, service, impact on power demand, etc., continuing and intensifying. That part, I think, will continue to do well. But we have to take into account the fact that national security and semiconductors now are completely linked.
But in terms of AI, when you've got the likes of Jensen Huang waiting for more imagination beyond his part of the chain, how do you play that in 2025, or how do you diversify as well?
I think you have to be diversified. I think you really have to think in that second generation of impact, on service and productivity enhancement, et cetera, et cetera. You have to think of not only the big guys, but also the smaller companies or the medium-sized companies who are going to be able to benefit more strongly. So it's a lot of bottom-up work. It's looking at it on a global basis, including in Asia, to make sure that you're not only concentrated in a few big names in the US.
Virginie, nice to see you. Thanks for stopping by to see
Thank
us.
you.
It was greatly appreciated. Virginie Maisonneuve, Global CIO for Equity at Allianz Global Investors. Let's talk about the Core 6 and see what's happening there. This is the centre of gravity here in Europe. This morning you've got Novo tracking a little bit higher, upgraded to buy at UBS as an attractive entry point, according to the Swiss bank. You've also got Nestlé double upgraded at BNP Paribas. Both of those two stocks, it's interesting to see what is happening. Novo is actually reacting fairly positively. Nestlé, much more of a muted reaction. LVMH is down. We've got chips moving higher, though. ASML, Schneider, both gaining traction this morning. Let's get some more details on those individual moves and what else we're seeing. Joe Easton joins us with more.
So we are seeing some movement in these wind stocks this morning, Guy. Vestas and also Ørsted declining around 4%, almost 5% on Ørsted. Of course, Donald Trump saying potentially that he will be looking to block all new wind projects during his term, and that would threaten potentially billions of dollars worth of projects. Remember, Ørsted did actually have a lot of cancellations in the US, so that is weighing on that sector today. Then in terms of defence, we are seeing moves higher there. As Lizzy mentioned a moment ago, seeing some decent upside, particularly Rheinmetall and Saab, as Trump says that he's looking for NATO countries to spend 5% of their GDP on defence. We'll have to see if that actually does go through, but they are moving on that news today. Then in terms of the bookies, some weakness in those gambling stocks today after Flutter warns it's been hit by gamblers doing well on some of their NFL bets, the sport I know absolutely nothing about, but we are seeing some weakness in the rival here, Entain, that one coming down almost 2% at the moment. Flutter in London, thin trading in that one. That did a relist to the US, as we mentioned earlier, nonetheless moving that market. Then in terms of TeamViewer, a big mover. Now this is the work-from-home technology company that rallied in the pandemic. It has had a big slump, but today beating expectations on their sales guidance. And look at that, 14% gain for TeamViewer in Germany, probably the best of the mid-cap stocks that we're going to get today. Then we've got morning calls. The first one, as Guy mentioned a moment ago, Novo Nordisk gets a buy rating at UBS. Now that stock, of course, plunged following the CagriSema data, which was disappointing. The participants lost less weight than expected, but as Guy mentioned, UBS reckons that is an attractive entry point now for that stock, so they go buy on Novo. Then finally, Nestlé. As you mentioned there as well, Guy, it is a muted reaction to the Exane outperform, but that is because Jefferies has actually cut the stock to underperform on the same day. So they've got a new outperform, new buy and a new sell over at Jefferies, which says the food outlook is weakening. So that is why we've got a muted reaction there. But Nestlé gets a couple of rating changes, unchanged at the moment over in Switzerland.
All right, Joe Easton from our equities team, we thank you bringing us the latest on those analyst calls. As we look at the stock 600, not doing much this morning, higher 0.1%. We had thought it was going to be a negative session, but really it's not as much of a muchness across European equities as a whole. We're going to dive into the impact of Donald Trump's pronouncements on wind next, as Joe was referencing. Vestas and Ørsted affected this morning. He says that wind farm construction during his second term in office is off the table. We'll discuss that next. This is Bloomberg.
"17 minutes into the session here in Europe. It's half of it's up, half of it's down. There you go. We're not going anywhere in a massive hurry here in Europe this morning, to be brutally honest. There are individual sectors and individual areas that are really interesting. Take a look at what is happening with defence. Take a look at what's happening within the wind sector. Take a look at what's happening within the tech sector. Also interesting. And that's really where I think a lot of people are focusing their attention this morning. You saw a big dump in Nvidia shares yesterday. This after a wide-ranging product presentation by CEO Jensen Huang. It failed to win over investors. Lizzy called it meh. I think that probably pretty much sums it up. He also spoke after that presentation to Bloomberg Technology. It was a wide-ranging interview. He talked to Ed Ludlow. He talks about the fact that he'd also be happy to meet President-elect Donald Trump and do what he can to help the administration succeed. I thought that was pretty interesting in terms of the narrative that we got coming through from him. In terms of the impact that we're seeing folding through into European tech stocks this morning, there is an effect. It's not that great. But you can see that there is an effect coming through from this. When US tech catches a cold, the rest of the sneezes, the rest of the world definitely, to a certain extent, catches a cold. But let's talk about what we can take away from what we've seen over the last 24 hours from Jensen Huang. We're joined by our executive editor for global technology, Peter Elstrom, around the table. That was a really interesting conversation he had with Ed Ludlow. We got a big market reaction, though. In some ways, it feels like what Jensen's talking about and the market reaction feel like they're almost on different pages at the moment. Just kind of talk me through what you thought was interesting. What are your takeaways from the last 24 hours?
I think, in a sense, they really are on different pages. It's important to remember, this is the Consumer Electronics Show that he's appearing at. He came out and he talked about consumer products in a number of different areas, including their GeForce graphics chips, which are really to drive these computer gaming machines that are so important to this segment of the market that used to be very important for Nvidia. It still is important for Nvidia. It used to be a majority of their shares, but now it's a small number of shares. He also talked about some of the new areas that are expanding into, including autonomous driving, some of the robot technology that they've got. But really what investors, I think, are reacting to is something quite different. What's really driving the revenue at Nvidia these days is their data center sales, their ability to sell the AI chips that are going to be put into these data centers to be able to drive the AI models at OpenAI, Microsoft, Google, etc. That is where the big money is coming from right now. And he did not give as much of a status update on the progress in making those sales as perhaps investors had been looking for. So this focus on consumer products, I think, again, at the Consumer Electronics Show may have conflicted a little bit with this idea of where the revenue are actually going to come from in the future.
But the diversification story still remains a headwind. And even though you look at the analyst commentary off the back of it, everyone's saying that they're still quite bullish on that long-term case. The progress, yes, I see as a potential headwind, but it hasn't, besides kind of paring back the stock a little bit, it hasn't really dented the momentum. And yet some of its big kind of tech peers also took a really big hit yesterday. Amazon, Apple, Microsoft, all the hyperscalers that are investing in Nvidia. How do you make sense of that?
Right. Well, I think they still have to prove that this AI growth story is real and it's long-lasting. Certainly right now, Nvidia, because it's selling chips to all these hyperscalers out there, they're making lots of progress. The revenue's growing very quickly. They would like to see more progress about how quickly that's going to go at this point. But on the other end of the table, they have to prove that these services are going to be profitable. OpenAI talked in the interview that we had with Sam Altman about how much of a struggle it is to actually make money from some of these AI services at this point. They need to be able to get to profitability to make sure that they can keep buying those chips in the future, which matters for Nvidia and it matters for really everybody in that whole tech supply chain. So we saw that kind of cascade across the tech industry yesterday as these concerns continue to bubble up because we need to see profitability at the other end of the AI model.
The actual tech aside, it was interesting as well when Ed asked Jensen Huang about tariffs, and I'm kind of wondering whether, Huang was extremely diplomatic here. Should he be banging down Trump's door for an invitation to Mar-a-Lago? How is Nvidia actually going to be impacted by the trade war with China?
Well, it's certainly a big issue for Nvidia in particular. They want to be able to sell into the China market. They want Chinese companies to be able to do business in the U.S. A lot of these CEOs grew up in an era of global trade, free and open global trade, and now they're looking at some potential headwinds on that front. So certainly he's been very aggressive in trying to sell the AI chips into China that he can. He's had a couple of different restrictions slapped on him by the Biden administration in terms of his ability to sell those. So I think he'd like to foster stronger relationships, let the businesses flourish and build their businesses. But, the reality, the politics are we have Donald Trump coming into office on January 20th.
All right, Bloomberg's executive editor for global technology, Peter Elstrom. Thank you. Good to have you round the table. I want to take a look at another industry that Donald Trump had his eye on yesterday. He was taking another dig at the renewables sector, saying that he's aiming to block construction of wind farms during that second term in office. Previously, he'd vowed to issue an executive order against the sector on his first day in office. And indeed, we've seen the hit to the wind stocks this morning, in particular Vestas. Those shares down 3.4%. As things stand. Ørsted even more so, down 4.4%. But let's get to Bloomberg's Rachel Morrison, who leads our coverage of gas, power and renewables in Europe for more. Rachel, just take us through how the shares are responding, why they're reacting this way.
The wind industry has been sort of braced and really dreading more from Trump on his plans for the sector. So we have in the past had some quite negative comments. And a lot of people are sort of putting that down to some of Trump's personal experience with a golf course in Scotland. So he sort of has said comments about how wind turbines are bad for whales, as in the sea creature, for which sort of have no evidence to support them. So it's not totally clear why he dislikes wind so much. But it really is a sort of growth sector, or was thought to be a growth sector for the US. So with Vestas, they would have expected to be selling turbines into the US. That's obviously looking less positive. And for Ørsted as well, they are a big developer, but also have projects in the US.
What impact can he have, Rachel?
Well, when it comes to permitting for new projects, he can have a lot of impact, and he can enact this, particularly for offshore wind or land onshore that's owned by the government. So not private land, but the leasing and the permitting for those projects can be blocked and can be stopped. So for projects that have already been permitted, they should be okay, but they'll be worried. But for new projects, this is really the sort of growth that will be stymied by this, potentially by what he plans to do.
So, Rachel, walk us through kind of this geographic allocation here. If the U.S. wind sector is such a big piece to these companies, in the absence of that expansion, if that's what happens the next couple of months, where else can that growth come from?
Yeah, it will be interesting to see what happens, how Vestas, who sell wind turbines, react to this. There are other markets. Europe is already a lot more developed when it comes to offshore wind and onshore wind than the US. But there are pockets of growth in Central and East Europe where companies will be looking to sell into the UK as well. For Ørsted is a big market. So really the developers follow the markets where the best incentives are on offer. So those are CFDs, contracts for difference, things like that, subsidies. And then the turbine makers then follow that. So there are pockets of growth. They may look more to Asia, but for the moment, it looks like the US will be a lot smaller of a market than hoped.
Bloomberg's Rachel Morrison walking us through that Trump story. Of course, you're already seeing it in the market reaction today. We thank you so much. Guy, you're the one who flagged this early on this morning, that you might actually see some sort of ripple effect in Ørsted Vestas. Rachel was talking there about what the kind of driver of this might be. In the U.S., his base is not a fan of renewables. There's been a real point of contention in terms of spending from Biden as well, and perhaps that's one reason.
What's interesting, though, is red states have had a really big boost from government spend coming through into this space. So in some ways, that's quite counterintuitive for his base not to be in and on board with this as an idea.
Yeah, and I think it's also coming at the fact that some of the kind of big oil is not renewables kind of narrative is still so plagued into there. But you've seen the likes of the major oil companies, Exxon, Chevron, who've actively, to cater to Biden's agenda, kind of rejigged their capacity, leaning into carbon capture, leaning into renewables, are now saying, wait, hold on a second, we kind of maybe want to keep that allocation that we've moved around on. So that's something to explore in the coming months, and certainly in the coming years as well. Coming up on the program, we go back to the markets. Europe's biggest equity bulls say the region can't beat the U.S. in 2025. That conversation next. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session and not much doing really on European equities. The CAC 40 in the red, though, down 0.1%. Maybe a bit of a hit from luxury there. You've got LVMH suffering this morning, but nowhere really making major moves this morning, Kriti.
Yeah, certainly something to keep in mind. Of course, this is through the broader market reaction. We're continuing to see a sell-off, specifically in the tech sector, Guy, when we were talking about that kind of pain that we had seen in yesterday's trade. Some of that's seeping into Europe, but I actually see SAP as one of the major kind of upside contributors to the stock 600 this morning.
It's interesting, isn't it? Tech's actually doing okay here. It's a mixed bag, but tech is doing kind of relatively well. So that's an interesting story. What I'm watching as well is what is happening in the bond market. Yields are actually moving a little lower this morning, certainly on the 10-year tenor across most of Europe. Just want to check in on the 30-year just to see what's happening there, because that's where the action was yesterday. UK's down a little bit. Elsewhere, we're actually seeing long European bonds moving a little higher in terms of the yield story. This is the core of the story that we're watching so carefully at the moment.
Yeah, that kind of interplay between the bond market and the stock market. When it comes to the stock market, though, we've seen such a sell-off in Europe, this doom and gloom look. Is that a reason to be more bullish on Europe? Well, a few of our guests on the show think that maybe it's the right time. Take a listen.
You see these indexes that actually have performed well this year, some of them more than the S&P equal weighted, and therefore you shouldn't ignore them completely. Great companies, strong indexes, don't ignore Europe.
There's a few things that could give us hope that Europe is going to see, if not double-digit upside to the market next year, then at least very high single-digit upside.
In Europe, there's a lot of companies in today that meet our criteria of being long-term winners. It's the European stocks today that have been dislocated last year that I think look a little bit more interesting.
Feels like we start every year this way. Europe's going to outperform. We're going to get a better performance coming through. The disappointment doesn't take long to show up. Deutsche Bank strategists have also turned overweight on European equities, citing opportunities for stocks to tactically outperform US peers in 2025. The team led by Maximilian Uller expects a 50% upside for the Stoxx 600 by year end. He joins us now. Max, good morning. Thanks for taking the time. What gets us to 50% upside on the Stoxx 600?
Good morning. Well, I think there are 5 reasons, actually. I think political uncertainty is getting better or lower. I think we'll have very positive earnings surprises in January, February. I think economic surprises are better than people kind of price in right now. I think China will be a positive surprise. Plus, look at the rates differential, right? We're talking about overweight Europe versus US. Rates differential between Europe and US, a lot more favorable for Europe than for the US. That's a very short summary. Happy to discuss.
OK, so when you take those arguments to particularly US portfolio managers, what do they say? How much pushback do you get against this idea? How high is the barrier at the moment for people listening to what you have to say and committing capital to Europe?
Yeah, so I think US investors are quite far away from buying European equities yet. I think there are 3 phases. First one is rather short-term money moving back into Europe. We see an underweight or net short in hedge fund money. Then I think the next step will be European investors, and then lastly, US investors. I think for US investors, we need 2 of those triggers to really happen, and that is, one is better politics in Europe. So we need a new coalition, we need reforms. I think that will drag in more interest from US investors. And number 2 is really good, effective communication of the next stimulus program in China. That's also something that's perceived to be very positive for Europe. So once we have those 2 triggers, I think US investors will come back. But again, that are not the investors that I expect to come very short term.
Well, Max, let me follow on your first point, then we'll get to the China piece as well. When you talk about kind of the levels to buy here, we look at it a lot in terms of the rate space. That if you say, hypothetically, a 10-year at 4.50 or a 10-year at 5% could disencourage or disincentivize investment in the U.S., does the same apply here in Europe from international investors? If you see parity on the euro, does it incentivize more fund flows into Europe just from the currency move alone?
Yes, so rates and currencies, I think both are 2 aspects that are getting a lot more favorable for Europe. Look at the impact of a stronger dollar on earnings. I said earlier that we expect about 10% earnings beats for Q4 earnings in the coming reporting season. And that's not even yet pricing in the higher dollar. So the higher dollar is supportive also for European exports. I think that's a positive. And on the rates differential, I think 250 in the bond, that's really not hurtful. If you look at credit spreads in Europe, no problem at all. If you look at how the risk return is in economic data and the reaction function of rates, it's very different to the US, right? If we have weaker PMIs, for example, in Europe, we've actually seen a positive market reaction because investors are anticipating the ECB to be cutting more. If we have positive news flow on economic data, we barely see any reaction on the Bund. Look at what we've seen with the inflation data earlier this week. Barely any reaction of the Bund. That was more driven by US data. And very different picture in the US, right? You get stronger job data. Equity market is reacting more negatively because markets are already expecting 3% perfect US growth, and any disappointment will be a disappointment for equity markets. So I think pretty different in the setup. And again, stronger labor markets in the US, higher rates in the US, and that's been the key worry this week.
So that's the relationship with the U.S. Let's talk about the relationship eastward as well. You mentioned the China angle. We talk a lot about on the show what the China playbook should be when it comes to the European equity market. Is it as simple as buying and selling luxury? Is it as simple as buying and selling basic resources at a time when the Chinese are trying to pump in this fiscal stimulus with mixed results?
Absolutely. So I think it's too early, and I would still want to wait for the communication that we'll see probably later in March and how effectful that will be. But don't forget that our estimate, for example, is that we'll have 10% more fiscal spending in China in 25 versus 24. That's quite massive. That should have some positive result. I just think the communication so far hasn't really been that positive. From a sector perspective, we are not yet overweight luxury. I think for that one it's too early. We still need to see results to get more credibility for those stimuli. For example, higher retail sales or sales in general in the sector. We haven't yet seen that. Maybe Q4 earnings season gives a first hint, but I think for that sector specifically, it's a little bit too early. But again, we have so many catalysts. China would be a little bit of a wild card late Q1, that would be another push for Europe. I think the other four catalysts that I mentioned earlier, they're already enough to push equity markets higher. China would be a very positive and welcome wildcard for Europe.
Max, where you talk about the bond stocks relationship, does it apply to the UK as well? You've seen this rise in the 30-year gilt yield. How worrying for UK stocks is that? Is it kind of an anomaly, the picture here in London?
Yeah, within Europe it is, right? Indeed, you have a bit of a similar situation in the UK that is similar to the US. However, if you look at the export structure of UK companies, they're very much more international than, for example, US companies. We've touched upon, or very shortly, your colleague touched upon metals and minings. I think for that sort of industry, it's less relevant. And then again, for the banking sector, it's actually good news that we have higher rates because that means higher NII for longer. So yes, it's more of a drag for UK equities than it is for Eurozone equities. However, not as tough as it is for US companies, I would think.
And you're not really worried about all this latest inflation data that we've had this week forcing the ECB to be more cautious and giving less of a helping hand?
We think that the inflation data that we've seen recently, that they're very temporary, quite some base effects. Our view is that inflation will come back down below 2. And if you share that view, then I would think that we are very likely going to be at 150 in Eurozone rates by the end of the year. I mean, compare the current environment to the 2010s, you'll find a lot of parallels, right? We have inflation, which we again think will be below 2 later this year. We have economic growth around 1%. We have high debt to GDP ratios in some of the core countries, so very similar to the 2010s. However, rates right now are at 3 versus average 0 in the 2010s. So quite a gap. Neutral rates are probably a lot lower, terminal rates also. So I think clear trajectory for the ECB to be cutting.
Max, great to catch up. Really useful insights. Everybody watching what is happening with the European picture as it develops through 2025. Maximilian Uller, Head of European Equity and Cross-Asset Strategy, joining us from Deutsche Bank Research. Thank you very much. Let's talk about what happens next in Europe from a different angle. The EU must be ready to defend itself from possible punitive trade measures emanating from the new US administration. That's the message from the EU Commission's Executive Vice President, Stéphane Séjourné. He spoke exclusively to Bloomberg's Ollie Crook about how the bloc plans to respond to the new US administration.
Europe will remain an open market and will not become a closed one. There's no gain in a trade war. However, Europe cannot be the only continent open to global overcapacity. Across the globe, markets are increasingly protective, with state aid marking our industries uncompetitive. This must be addressed. We have both offensive and defensive trade instruments that we must activate as part of a comprehensive economic strategy. This marks the end of European complacency or excessive openness. We need to protect our industries when they are not operating on a level playing field.
And one of the great risks to the European economy and indeed to European industry will be tariffs that have been promised by Donald Trump, obviously something that you're paying very close attention to. I want to ask specifically about steel tariffs, because if there is no deal by the end of March, as you know, there will be steel tariffs between the United States and Europe. Are you prepared to support European industry if that comes to pass?
Regarding steel, there is no automobile or wind power industry without steel. So if we want to be able to build automobiles and wind turbines in Europe, for example, for carbon neutrality, we need a European steel industry. We will have a plan to protect the steel sector from global overcapacity while ensuring competitiveness. I'm prepared to explore both defensive and offensive actions with my colleagues at the Commission. This is a dialogue that we will have at the Commission. I still hope to convince the next U.S. administration that we have everything to lose from a collective trade war. Europe is an economic power with 450 million consumers and must be viewed as such. Our goal, our responsibility, is to be united as 27 nations to be able to negotiate.
The EU Commission's Executive Vice President Stéphane Séjourné there with our very own Oliver Crook in Brussels. Ollie joins us now from the Bureau. Ollie, I love that you asked him about steel tariffs, these quotas that are hanging over and basically on ice until Donald Trump takes office. What's the roadmap? How are the Europeans preparing?
Yeah, so listen, I mean, this is a new job, the Executive Vice President, technically for Prosperity and Industrial Strategy. You know, we call it the Competitiveness Commissioner. And basically what he is tasked with is basically implementing a large portion of the Draghi report across a number of different industries. But again, one of the main focuses that they're going to have very, very early on is this question on heavy industry, because we have not got very specific details about the actual policy levers that they're going to pull. I think this was more of an instructive conversation in terms of how they're thinking about doing this. And really, I think for Stéphane Séjourné and this Competitiveness Commissioner, it's all about bridging the old industries to make sure that the old industries, that the new industries are dependent on, like steel for, say, wind turbines and automobiles, basically the old industries don't die, while at the same time investing aggressively in the sort of new industry. So that means supporting steel, aluminum, heavy industry, the autos, but also the chemical sector, to a point that there is enough of that in order to throw it forward into this sort of question about renewable energy, you know, battery technology and these sorts of things. But frankly, these are not areas in which, you know, Europe is really winning right now. They do have some strong sort of wind companies. Solar, they certainly are not at all really players. And again, sort of the chemical sector and all those sorts of things are some of the things that have been the hardest hit. So the question I had for him, because if he's going to implement the Draghi agenda, a large part of the Draghi agenda is spending up to about 800 billion euros every single year. I asked him if it is realistic for them to do so without the use of joint debt. Have a listen.
Yes, it is realistic because, first of all, if we add the competitiveness policies of each member state plus the European budget, we are not very far from the investments that need to be made. I will push to implement the whole Draghi report and nothing but the Draghi report, all the components, including the investment aspects.
So listen, they need to implement this Draghi report. He's saying that basically they don't necessarily need to tap joint debt in order to do that. Again, this is a very sort of sticky and thorny issue. And I think once you get more concrete plans about where money would actually spend, you can actually start talking about that. We will get the sort of a new clean industrial deal. That is something that we're going to get a lot more detail on. That will come in February. But again, these are sort of the way that they're sort of trying to frame this, going in not only to a sort of very more hostile environment with the Trump administration, but again, the prospect of a trade war between China and the United States. That means a huge amount of overcapacity coming into Europe, and that is something that is weighing on these officials right now.
Ollie, great stuff. Great interview. Thank you very much indeed. Ollie Crook joining us after that conversation. How does Europe progress from here and deliver on Draghi? Coming up, we're going to be talking more about what is happening in these markets. A firm focus on what is going on in the bond market still represents kind of the centre of gravity, I think, for a lot of people right now. We'll talk more about that next. This is Bloomberg.
can you set the record straight? Is Greenland still not for sale then?
We have had that discussion already, and I don't think there's any good reasons to enter that again.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No. I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security.
Donald Trump speaking there yesterday, certainly putting the cat amongst the pigeons. The comments from Denmark's Prime Minister, that was back in September. President-elect Donald Trump speaking yesterday. This is still a live issue. Trump declining to rule out using military force to either seize the Panama Canal or Greenland. Let's bring in Bloomberg's Brussels bureau chief, Kevin Whitelaw, who's got long experience of covering these types of stories. Kevin, what should we make of the comments yesterday?
Well, look, I mean, this really was a throwback to sort of the freewheeling style that we all sort of got used to in Donald Trump's first term, and it is it is a reflection of what he's thinking at any given moment, but it's not necessarily something that tells you exactly how things are going to play out over the next days, months, or years. Greenland was an issue he talked about as president the first time round, and he talked about having an interest in it. It never ended up really going anywhere other than causing a little bit of a stir. He's obviously back at it now. I think the question down the line is going to be, what exactly does he end up doing? How seriously does he pursue it? And what does that really mean? You can see that Denmark is already trying to find ways to blunt some of this. They're saying that they're open to deals. They're ready to do business. Greenland's open for that. But at this point, obviously, there's zero interest in trying to indulge Donald Trump in the idea of somehow purchasing Greenland.
Well, Kevin, I just want to kind of nerd out on Greenland for a moment, because I want to argue the other side of this. Does he have a point here? I mean, when you Google this stuff, there is ancient Cold War doctrine that says the U.S. already has military access to this part of the world. Does he have a point in terms of pursuing whatever it is he's pursuing in this part of the world?
Well, I mean, to the degree that the U.S. may have national security interests, there's already a certain amount of U.S. military presence in Greenland. And so, the idea that the U.S. would like to expand that is something that actually could happen within the existing structures, right? I mean, this is all part of sort of NATO and other existing security structures. So it's a question of what exactly he is looking for here. And is he looking for something that is about sort of bolstering a military presence? Is it about access to some kinds of minerals? Or is he really looking for the prestigious idea of something that is about enlarging, the United States and sort of having the Trump purchase, if you like, and as sort of his real estate days coming back to roost. So I think ultimately the question down the line is going to be, what is it he's really looking for? And I'm not really sure, even though this issue has come up before, that people have a fully clear idea of why he is so fixated on Greenland.
Well, on the military theme, Kevin, he's also asking NATO allies to spend 5% of GDP on defence when the US isn't even doing that itself. Are we meant to take it that this is what he's going to do? Do we, by extension, take any of this seriously, or is it really all noise?
Well, I do think it has to be taken seriously, but maybe not literally. And so, obviously, Trump was pushed Europe very hard on defense spending in his first term, and a number of European leaders, including the former and current Secretary General of NATO, have credited him with helping to drive this issue and helping to focus European countries on the need to spend more on defense. Obviously, the war in Ukraine has only solidified that and made that more urgent. When Trump was president before, the target was 2%. We still have 2 or 3 countries that are just barely getting to 2%. And NATO itself is talking now about 3% as sort of the new idea of a notional target. Do they get to 5%? There's simply no fiscal room in most European budgets and probably not the U.S. budget also, given the tax cuts that Donald Trump is talking about. But is Europe going to feel the pressure to keep boosting spending on defense? Yes. Are they going to feel the pressure to keep boosting spending on Ukraine? Yes, they will. And that's exactly what Donald Trump wants them to feel.
Yeah, you go for the maximalist approach, you push the numbers high, and then you maybe deliver a more realistic number. Kevin, great to catch up. Thanks very much indeed. Kevin Whitelaw joining us on the politics, the geopolitics. Let's talk about kind of what is coming up a little bit later on in terms of the data, Kriti. Data moved the market yesterday in a fairly big way. And we saw the ISM services number really kind of moving things around. The JOLTS number can't be ignored either.
Yeah, the outperformance that you're seeing basically in the United States continuing to take those Fed rate cut bets off the table, potentially more in the hours ahead. At 1:15 p.m. UK time, the ADP jobs data, the private basically numbers are going to come out, potentially kind of paving the way for what we're going to get on those non-farm payrolls as well. 1:30 p.m. UK time, some Fed speak from the Fed's Waller on the economic outlook, and then the ECB speak to fall that 5:15 p.m. UK time. Villeroy speaking in Paris. And then, of course, maybe the main event, 7 p.m., the FOMC minutes this morning.
It's going to be fascinating.
This afternoon.
Yeah.
Whenever it
afternoon,
happens.
this evening. Sometime, I think it's 7 p.m. UK
7 p.m.,
time.
so evening.
So evening for us, close to bedtime. I'll be taking a look at what is happening. I go to bed early. So does Valerie, I suspect. She's sitting around the table joining us to discuss all of this. We could get a hawkish set of minutes, which will be interesting as well, because that could even add extra juice into this bond market move that we're seeing right now.
Yeah, the question is just how, the market's already very much adjusted to the hawkish surprise we got in December. Is there really going to be anything in these minutes to kick it more, right? Yeah. Well, right now, the market is pricing in a Fed on pause until July, so that's a substantial amount of next year where the Fed isn't active. Maybe we do get some hints in this minutes on just how close that call was to cut rates in December, maybe foreshadowing, that descent that we did see. Maybe this Fed is going to be on hold longer than they expected. The cementing January is what we might, get from these minutes, but it's not going to surprise the market very much. What I do think the market is going to focus on is the political side of the story for the Fed. We heard from Fed Chair Jay Powell in the press conference talking about some members already having adjusting their forecasts, preempting these economic policies we're likely to get out of Trump. Just how much did that play in the discussion? Just how much did that play in their revisions to growth and their upward revisions on core PCE growth for 2024? I think that's what the focus is going to be.
You had Ben Rahm earlier on the program talking about a one standard deviation move being anywhere from 330 to 550. That was the range he suggested, at least that the Treasury markets are pricing in. Is there a case for 350 on the 10-year?
Look, we would have to see a very big shift in the economic outlook for the U.S. We'd have to see this economic data turn around. We've not gotten that at all yet. We've had a string of hot data to start the year. Maybe NFP on Friday changes the tune. But to get a big rally in the Treasury market, would definitely have to see some weak economic data.
All right. Bloomberg's Valerie Teitel walking us through the Treasury market dynamics. And we had her this morning, like I said, saying what is actually driving these markets. And she gave me a laundry list of things. There's just no way to narrow it down because everyone is hedging and preparing in a different way.
We're waiting for Trump. We're waiting to figure out. That seems to be the biggest variable right now. Yeah. What happens on the 20th? What are we really going to learn? Everything feels like preparation for that.
More uncertainty. That's what happens.
Yeah, the uncertainty there's just as Valerie says, just multitudes of multiple factors being folded into the market at the moment. But how much of it's accurate and how much of it's not? This feels like a really difficult January to navigate. Ed Bastian's going to be joining the team a little bit later on. That conversation from the Delta CEO coming out, I think, of CES. Looking forward to hearing what Ed has to say about the global economy. That wraps things up for the opening trade. The Pulse is coming up next. Hope you enjoyed the show. This is Bloomberg.